Good evening and welcome to our webinar on Invest Wisely in FY'23. PRS Head of Equity Research, S Securities. My name is Akash Agarwal and I'll be anchoring today's webinar. In this webinar, Ms. Shankar will provide a 360-degree perspective on the equity markets to help all of you get a holistic view of the changing investment environment and the opportunities that lie ahead in the coming financial year. Before we begin, let me explain the flow of this webinar. There will be a 30 to 35-minute session where Ms. Shankar will address and give her views on equity markets and the outlook for FY'23. Post which, we will open the floor for questions from the participants. One humble request to all our esteemed viewers, kindly post your questions in the chat section related to today's topic only. Ms. Shankar would not comment on any stock specific queries in this webinar. So please ask your questions accordingly. So without any further ado, let's begin our webinar. Over to you, Nitasha.
Thanks, Akash. Good evening, everyone, and thank you for joining us today. So, we are at a very exciting phase of the overall equity market scenario, and that's why we thought that it would be a good idea for us to connect and talk about what are the areas that one could invest in, especially when it comes to equity markets. My talk is largely going to be divided into three parts. The first part, we would talk about what's really happening in the equity markets. The second part of it, we would talk about what will drive returns in the equity markets in the coming months, quarters, and years. And finally, we will touch upon which are the areas or which are the sectors that one could look at in order to maximize your long-term returns. Now, essentially, before we start off, one thing that I would like to point out is that what we're really talking about here is the long term scenario, and would be refraining from giving any comments or any information as far as the short term scenario is concerned. Now, how equity markets have really panned out. Essentially, equity markets have underperformed pretty much your crude oil as well as gold, especially when you're looking at the near term returns. Now, for the month ended March, both Nifty as well as Nifty Mid Cap gave moderate returns. Small caps, of course, outperformed, but it was nothing in comparison to what we saw on the crude oil. Now, one of the reasons why equities have underperformed, the commodity sector, especially crude, especially when you're looking at the YTD gains, one of the reasons is what is happening in Russia and Ukraine. Now, it is a known thing that whenever the sentiments turn negative, whenever there is volatility, whenever there is uncertainty, equities tend to underperform during those particular months. Now, the second part of it is, of course, there was a surge in commodity prices, particularly crude oil, and that negatively impacts India, especially because it tends to have an inflationary pressure. We are largely importing about 80% of our oil needs, and of course, the surge in the prices does come in at a negative time. At the same time, inflationary pressure has also been caused in other commodities, particularly in metals, and we will touch base a little more about that in the going forward in the presentation. The another thing which has affected equity market returns, especially in the past 6 to 7 months, has been the constant selling as far as our foreign investors were concerned. Of course, this was offset by the buying on the domestic institutional side of it. Nevertheless, the kind of outflows that we saw, they have impacted equity market returns. And largely that is because of central banks trying to balance between inflation and economic growth. Trying to get increasing interest rates, increasing rates in the last week, and we do at about 6 to 7 hikes in the coming months. Now, if you're looking at a sectoral performance in terms of the YTD gains, of course, barring metals and oil and gas, pretty much all of these sectors have underperformed. We saw also give you nominal gains, but other than that, pretty much all of the sectors have underperformed, including realty sector, which was one of the outperformers, especially in the calendar year ending 2021. Now, one of the reasons, of course, behind it is the overall volatility in the markets, which has led to this kind of underperformance. But more or less, what has happened is if you're looking at the overall Russia Ukraine conflict, a couple of things that did stand out of it was this entire belt is commodity rich, especially when it comes towards the crude oil part of it. They do provide, they're the largest supplier of gas in the European region. And because of that, prices vary quite a bit. Most of the sectors in India tend to commodity consumers. Therefore, the commodity consumer sectors did underperform. However, metals and oil and gas did outperform because they did see a substantial amount of gains in the recent months. For this, when you look at the markets overall, it is very important to try and understand what would be driving equity returns. And so we thought that we just touch base about what would pretty much drive equity returns. The first part of it is fundamentals. When it comes to fundamentals, you're looking at scenarios when it comes to scrutiny of study of managements, the demand supply situation, the macro situation, the financial positions, looking at the returns, etc., etc. The second part of it is are how react to news. It could range from being extremely depressed, which is when you typically see a large sell-off happening in the markets, to people being extremely jubilant in the markets, and also markets at the peaks. But interestingly, no matter what, you will always find that this cycle is going to play out. You will have times of jubilation, of depression, but no matter what, money can be made in equity markets pretty much at any point of time. However, because the fundamentals are important, you will never be able to time the market accurately. Unfortunately, that's something which everybody has been trying to do. Most of us end up doing that through fluke, but most of us have to study the fundamentals in order to understand when to invest in the equity market. When it comes to the correlation between the fundamentals and sentiments, essentially, when you're looking at shorter term performance of the markets, the sentiments play a very important role. And when we start looking at longer term, the fundamentals start playing a very important role. Now, of course, sentiments are something which are very volatile. Therefore, one has to turn towards fundamentals when it comes towards investing in equity markets for any period of time. And that brings me to why it really makes sense to invest in equity markets, especially Indian equity markets at this point of time. Now, we have, I'm sure that all of us have read about it and all of us have talked about it, that India is on the cusp, and you're looking at a multi year growth, multi dimensional growth coming in to the country, especially on the it, and that is what actually creates opportunity to invest in India. The first thing which is happening is all the government schemes, and government has been very supportive, especially during the pandemic part of it. And during the pandemic, they had started implementing a lot of policies. The aim of these policies was pretty simple. We were looking at ways to sustain economic recovery, especially through taking care of the demand side measures, and the supply side recovery was to try and kickstart the investment cycle and encourage people to participate in it. And at the same time, there were policies which were very directly related towards domestic production as well as manufacturing, especially in the emerging sectors like clean energy, etc. These are the sectors which are critical when it comes to boosting the medium term growth prospects in the country. The second thing which the government has done is to look at the PMAY scheme. PLI scheme, which is essentially production linked incentive scheme, has been announced in several sectors. The idea being that you're trying to boost manufacturing in India or boost production in India, and for that certain incentives are to be paid out to various sectors. Now, as per ICRA, which is the credit rating agency, the PLI scheme itself has the capacity to attract capex of approximately 4 trillion rupees over the next 5 years and generate employment for about 3 million skilled as well as unskilled labor in the country. Now, these numbers alone can talk about the kind of growth prospects that one can expect coming into the country. The third area, which is creating a huge investment opportunity in the country, is the China Plus One strategy. Now, post pandemic in particular, the developed world has realized that they need to move out as far as the domestic, or as far as meeting their needs are concerned, in various areas. It could be as manufacturing bases, it could be in terms of sourcing materials, and diversify the base. So they are looking at different countries. So they're looking at China plus one as a way to try and overcome the limits on China, and India is a huge beneficiary of the same. Now, sectors where India does benefit, especially on the China Plus One strategy, one is the specialty chemical sector. And we have seen specialty chemicals outperform in the near time. In fact, over the recent past, over the recent years, we've seen a huge surge as far as the performance of specialty chemicals is concerned. Much of this has been driven by actual orders, the order book, and the kind of capex that is required to meet that. Another sector which has benefited from this entire China Plus One strategy is the textile sector. India does have industries over here, and India has over as a big hub as far as the textile sourcing is concerned as well. So these are just some of the examples that you have as far as the China Plus One strategy is concerned, and that is another area which is boosting the growth in the country. Overall, energy. Now, clean energy has become a source of investments as far as the country is concerned. We're looking at various areas, alternative uses of power, electric vehicles, the entire EV space for that matter. Ethanol blending is that's also a part of your clean energy, which is giving a boost to sectors like sugar. Overall, the kind of spend which is happening on the clean energy part of it is another area which is transitioning as far as the investment opportunity in the country is concerned. In fact, as per the corporate sector, the sector has a potential to scale up to about 500 billion US dollars over a period of 20 years itself. Now, given this huge opportunity in India, it really makes sense to remain invested in it. The other areas, which is actually when you're talking about all of this investment which is happening, one starts wondering if are there actually examples of this entire opportunity playing out. Now, of course, investment as cycle, like I said, that the government policies have resulted in the investment cycle picking up in the country, and this chart itself, which has been sourced from as well as ICICI, can see that the investment cycle has started to pick up. If you look at the sum total of the kind of capex which the state governments, the central governments, as well as the listed governments are doing, there has been a trending up. In fact, the past TTM, which is trailing 12-month basis for FY22, it has already scaled up in, which is higher than what you saw on at the FY21 side of it. Now, all of this, of course, would is also helping the credit growth back because obviously, in order to fund the capex side of it, you will need loans. Companies have started going ahead with it. Largely, most of this is coming in from the energy sector, from the metal sector, from the utilities sector, and these are the larger sectors when it comes towards capex, and those are the ones who have actually been driving the credit growth. In addition to this, credit growth has also been driven by the retail segment, that is basically from you and I. And you've seen a huge surge coming on the credit card spending, a huge surge coming in as far as the new credit card issues are concerned. Home loan, of course, is making a comeback as well, and all of these things are driving the credit growth in the country. The corporate balance sheets itself also are very well positioned in order to play out this entire growth story of India. Of course, the kind of debt levels that we had seen way back in 19 and even in 2020, they've started coming down. People have either paid back debt or they have invested in order to make sure that they have the kind of funding available in order to play out the overall growth in the country and to play out the overall growth in the country, and they're well positioned now. That brings us back to the main criteria as to what should one invest in. Now we have established that India makes sense today. India is of recovery. We're going to see multi-year growth coming in. We're going to see multi-year earnings growth coming in. However, one does wonder as to which are the areas that one should invest in. Now, till the end of 2021, which is till December 2021, we had largely seen a lot of news coming in, largely on the growth side, growth sectors, sectors which were showing growth. In terms of thematic sectors, we had a lot of themes that really played out for us. We saw companies who were really profitless companies, but they were really largely concept stocks, new concepts that came out, and with their IPOs, etc. And those are the kind of sectors and stocks that pretty much drove performance as far as 2021 calendar year 2021 or even 2022 2020 were concerned. But the kind of phase that we are in today, one has to be careful when it comes to investing in such stocks, because today the scenario is very different from what it was at that particular point of time. One thing that one has to remember is that inflation was benign and interest rates were low, plus liquidity levels were quite high in the world. And even in India, this scenario was pretty much the same. However, especially with the commodity prices raging upwards, both in terms of crude as well as in terms of metals, the scenario is very different. We are seeing a lot of stickiness coming in as far as the inflation is concerned. In fact, with every $10 increase in crude prices, we see about a zero point 0.4 to 0.5% increase in inflation as far as India is concerned, given the fact that we are importing 80% of our crude oil needs. So this does put our central bank into the dilemma as to whether they should increase interest rates or not. Therefore, the economic recovery that we are going to be seeing coming in could be combined with an interest rate hike as well. So, under such a scenario, one does start looking at quality stocks and value stocks. It's no longer the scenario where it is quality at any price, it has become quality at a price. And that is something which is very important to remember when it comes to investing in FY'23. The value by the what do I mean by quality at a price? You need to be sensitive when it comes to valuations. Now these valuations could be arrived through discounted cash flows, it could be through PE, it could be to EV EBITDA, it could be through price to book, whatever it is. Point is very simple, the point is very clear. You need to make sure that you're investing in a stock where the stock price is lower as compared to its intrinsic value. In terms of sectors, we're quite bullish on those sectors which are going to be riding out the overall India growth story. Like I said, sectors which are benefiting from the China plus one story. That's an area which one has to be positive on. Specialty chemicals in particular is an area which has boomed and which would continue to see boom. Interestingly, that is also a sector which has a very deep economic moat. What do I mean by that? It is very difficult for another company to enter into that sector because of the kind of complex chemistries involved. It is very difficult for them to build up the kind of market which is available over there. So the market share of the existing players is quite high, and therefore it becomes formidable when it comes to a new player. So that's an area which we're quite positive on. Textiles, of course, is another area which one is positive on. The third area, which is interesting, is of course the energy area. It's pretty much at a very nascent stage, so therefore the growth opportunity is huge because the market size or the estimated market size for the same is huge. It could be played out either through the entire electric vehicle story, or it could be played out through the clean energy story, through alternative energy story. And of course, it can also be played out through the entire ethanol blending story. Whatever it is one area which one needs to be invested in. Banking, of course, is something which one can never ignore, especially banking is the backbone of our economy. There is growth visibility over there at least for the next 1 to 2 years. Interestingly, banking has underperformed broader markets in the recent times, because of which the valuations have become extremely reasonable vis-a-vis when it comes to be compared to the rest of the markets. Of course, you will have short-term concerns in credit growth, or you can have certain amount of technological disruptions coming in, but overall, banking sector is one sector which can outperform the rest of it. Second, the fifth area if one is to invest in is the overall infrastructure, manufacturing, and capital goods sector. Like we've touched on earlier, the government schemes, the government capex, and most importantly, the PLI schemes are certain schemes which are driving the demand for that area, for these particular sectors, and the order books are strong. Order book scenario looks quite promising, and it really makes a lot of sense to be invested in them. Healthcare and pharmaceutical, again, two sectors which one cannot step away from. Of course, in case of pharmaceutical in particular, while the relative valuations are quite reasonable, one has to be a little sensitive when it comes towards the pricing environment, particularly in US, because US is the largest market when it comes to pharmaceuticals. And most of the companies over here in India, especially, are exporters towards US, and US forms a large chunk of it. So, of course, a broader recovery in pricing is something which one has to be sensitive to. But having said that, there are stock specific. Investment opportunities which are available in the pharmaceutical sectors, especially for those who have been able to crack our niche for themselves, and who are seeing incremental spending coming in and incremental margin improvement happening. And finally, we are looking at the overall IT companies, of course. Technology has become a part and parcel of how we perform in the world. Digital spends are here to stay. In fact, although digital spending has been scaling up pretty much across the sectors, no matter which sector you're really looking at, the deal sizes too have been improving. The deal durations have been improving, and most importantly, the margins have been improving. One can definitely play this sector out today, despite the fact that it has run up significantly. Overall, when it comes to markets, we do believe that mid cap and small cap areas provide you more opportunities to play out the sectors that we've really spoken about. And we could see the broader markets outperforming the headline index of Nifty as well as Sensex in the coming months as well. Just to conclude, overall, the market sentiments do remain quite subdued at the moment. However, the long term scenario for Indian equity markets remains robust. There are opportunities to play out the entire domestic growth story in the coming years. There are sectors which are available to an equity investor. However, one has to remember that the coming fiscal year would be looking at quality at A going to play an important role. Therefore, it's important for all of us to structure our portfolios towards these themes, and we
For the insights. I hope our viewers can take a few hours session with in the upcoming financial year. A humble reminder again to all our viewers and participants, if you have any questions, kindly post them in the comment section. We will commence with the Q&A session in the next couple of minutes. Thank you so much. Well, as we see, they have no questions from our viewers. So we have come to an end of our webinars because of that. And we'd like to thank Ms. Nitasha Shankar for appearing and sharing her views and joining us today with the valuable insights. We are confident that this session would help all our participants to explore equity investment opportunities.
Thank you all
Thank
and
you
have a
all and have a wonderful day.
Thank you.
Bye.